This is why 90% of smart money traders fail. You find a perfect break of structure, wait for price to return to your order block, and get stopped out immediately. You didn't spot a setup. You are the setup. Look closer. The institutions engineered this entire push to manufacture liquidity. It's a trap. The real institutional entry isn't this order block. It's the exact moment price sweeps it. Let's start with basics. In a bullish market, price creates higher highs and higher lows. Each time price pushes above a previous swing high, that is a break of structure to the upside. It tells us that buyers are still in control and the trend is continuing. In a bearish market, price creates lower lows and lower highs. Each time price pushes below a previous swing low, that is a break of structure to the downside. It tells us that sellers are still dominant and the trend is continuing in that direction. A break of structure is simply price moving beyond a previous significant high or low in the direction of the current trend. It is confirmation that the trend is still intact and the market is not showing any signs of reversing. The reason break of structure is so important is because it tells you who is in control of the market at any given moment. When price keeps breaking structure to the upside, buyers are consistently overpowering sellers. Every attempt by sellers to push price lower is being absorbed and reversed. That is a market you want to be buying in, not selling. When price keeps breaking structure to the downside, sellers are in control. Every bounce is being sold. Buyers cannot sustain any upward move. That is a market you want to be selling in. Without this information, you are essentially trading blind. You might have a great-looking setup on the chart, but if the structure is telling you the trend is going the other way, the probability of that trade working is much lower. Break of structure keeps you aligned with the direction that has the most momentum behind it. Not every move beyond a high or low qualifies as a meaningful break of structure. Price constantly makes small moves in both directions. We are looking for breaks of significant swing points, not every minor fluctuation on the chart. A significant swing high is one that price clearly pulled back from. It is a level where the market paused, reversed, and moved lower for a meaningful amount of time before attempting to push higher again. A significant swing low is where price clearly bounced from. The market paused at that level, reversed, and moved higher before attempting to drop again. When price breaks beyond one of those meaningful levels, that is the break of structure we want to pay attention to. A break of a minor high or low that barely registers on the chart does not carry the same weight. The candle that creates the break also matters. A strong, full-bodied candle closing clearly beyond the level is a much more reliable break than a candle that barely pokes through with a wick before pulling back. We want to see price close beyond the level, not just touch it. On the Euro-Dollar 1-hour chart, price creates a clear swing high that it pulled back from significantly. When price pushes above that level with a strong bullish candle closing above it, that is a valid break of structure to the upside. It confirms that buyers are still in control and we stay biased to the long side.
Once you start reading breaks of structure consistently, setting your market bias becomes straightforward. You look at the most recent sequence of breaks on your higher time frame and let that tell you the direction. If the last 3 or 4 breaks of structure have all been to the upside, the market is in a bullish phase. Your bias is long. You are looking for opportunities to buy, not sell. If the last several breaks have all been to the downside, the market is in a bearish phase. Your bias is short, and you are looking for selling opportunities only. This keeps you out of a lot of bad trades. When your bias is clearly bullish based on the break of structure sequence, you stop looking at bearish setups entirely. You wait for price to pull back and give you a reason to enter long. That discipline alone improves your results significantly over time. On the dollar-yen 4-hour chart, price creates 4 consecutive breaks of structure to the upside over several weeks. Each new high is broken and price keeps stepping higher. The bias is clearly bullish. A trader who stayed aligned with that structure and bought every meaningful pullback would have been on the right side of the market throughout that entire move. After price breaks structure, it rarely just keeps going in a straight line. It usually pulls back. That pullback is where the opportunity lies. When price breaks a swing high to the upside, it often leaves behind a fair value gap or an order block in the area just before or at the break. Those zones mark where the buying pressure was strong enough to push price through the level. When price pulls back into those areas, it often finds support and continues higher. The same happens after a bearish break of structure. Price breaks below a swing low, pulls back slightly, and then continues lower. The area around the break often contains a bearish fair value gap or order block that acts as resistance on the pullback. This is how break of structure connects directly to your entry strategy. The break tells you the direction. The pullback into the zone created by that break gives you the entry. On the pound-dollar 1-hour chart, price breaks above a significant swing high with a strong bullish candle. That candle creates a fair value gap just below the broken level. Price pulls back into that gap over the next few candles. On the 15-minute chart, a change of character to the upside forms inside the gap. We enter long, place the stop below the gap, and target the next swing high above. Price pushes higher and hits the target cleanly. Break of structure does not exist in isolation on one time frame. It is happening simultaneously across all time frames. The key is knowing which time frame to use for your bias and which one to use for your entry. The higher time frame break of structure tells you the overall direction. If the 4-hour chart is breaking structure consistently to the upside, the trend on that time frame is bullish. That is your primary bias. You are looking to buy. On the lower time frame, price will often create its own smaller breaks of structure in both directions as it moves. A small bearish break of structure on the 15-minute chart, while the 4-hour chart is bullish, is not a reason to sell. It is simply a pullback within the larger move. When the 15-minute chart gives a break of structure back to the upside after that pullback, that is the signal to enter long in the direction of the 4-hour trend. This is what top-down analysis looks like in practice. Higher time frame break of structure gives the direction. Lower time frame break of structure after a pullback gives the entry trigger. On the Euro-Dollar daily chart, price is breaking structure consistently to the upside. On the 1-hour chart, price pulls back and briefly breaks structure to the downside. A trader using only the 1-hour chart might go short. But a trader who checked the daily chart first would recognize this as a pullback. When the 1-hour chart gives a break of structure back to the upside, that is the entry into the daily bullish trend. The stop goes below the 1-hour pullback low, and the target is the next daily swing high.
These two concepts are closely related, but they mean very different things, and it is important not to confuse them. A break of structure happens in the direction of the current trend. It confirms that the trend is continuing. Price breaks above the previous high in a bullish market. That is a break of structure. It is not a signal to look for a reversal. It is a signal to stay in the trend. A change of character happens against the current trend. It is the first break in the opposite direction. In a bullish market, a change of character occurs when price breaks below a significant swing low for the first time. That is not just a pullback. That is a warning that the structure may be shifting. The difference matters because each one calls for a completely different response. A break of structure tells you to look for entries in the trend direction. A change of character tells you to pause, reassess, and start watching for a potential reversal setup. On the pound-dollar 1-hour chart, price creates multiple breaks of structure to the upside. Then price breaks below a swing low for the first time. That is not another pullback. That is a change of character. From that point, the approach changes completely. We stop looking for long entries and start watching for the structure to confirm a shift to the downside. Now let us walk through exactly how this looks on a real chart from start to finish. On the Euro-Dollar 4-hour chart, price had been in a bullish structure, making higher highs and higher lows. After the most recent push higher, price pulled back, and for a moment, it looked like the structure might give way. The pullback was deeper than the previous ones, and sellers were pressing. Then price found support above the prior swing low, which kept the higher-low sequence intact. A strong bullish candle drove price above the previous 4-hour swing high. That was the break of structure. On the 1-hour chart, that push left a fair value gap below the move.
Price retraced into that gap over the next few candles. On the 15-minute chart, buyers absorbed the selling, and a change of character formed inside the gap. We entered long at the beginning of the fair value gap. Stop below the gap. Target the buy-side liquidity sitting above the most recent swing high on the 4-hour chart. On the pound-yen 1-hour chart, price had been making lower highs and lower lows across an entire session. After the latest drop, price swept below the most recent swing low and immediately reversed. A sharp bullish candle drove price back above the previous lower high on the 1-hour chart. That was the break of structure, confirming the sequence had flipped. On the 15-minute chart, that bullish push left an imbalance below the move. Price pulled back into that zone, and sellers tried to push it lower. For several candles, it genuinely looked like the move might fail. Then buyers stepped in at the bottom of the gap, and a change of character formed on the 5-minute chart. We entered long from inside the 15-minute gap. Stop below the imbalance. Target the swing high above on the 1-hour chart. Break of structure is not a complicated concept, but it is one that requires consistency to apply well. Price is always telling you who is in control through the sequence of highs and lows it creates. When that sequence keeps stepping in one direction, the market is giving you clear information about where it wants to go. Break of structure tells you the trend is continuing. But what is the signal that tells you the trend is completely over? What does it look like when the market is about to fully flip direction? Most traders miss it entirely or mistake it for just another pullback. That signal is a change of character, and getting it wrong is one of the most expensive mistakes in this approach. That is the next video.